All right, cool. Hey, morning, everyone. Weather has been lovely in New York. I'm Matt, founder and CEO of Laurence. Basically, we automate Amazon advertising for brands. And today, I'd like to talk to you about the core underlying principles that guide what we do at Laurence and how we approach advertising as a concept, and how kind of quant trading is actually the perfect parallel to digital advertising in 2026. A little bit about us. Why should you listen to me, someone who looks and sounds like someone who's just come out of high school? I was a math and computer science double major at Cornell. I worked at an AI research lab applying machine learning and natural language processing to discovering new chemical formulas. And then I worked for 3 years as a machine learning engineer at Google and Meta. When I was at Meta, I built the friend suggestion notification algorithm, the one that you guys probably get spammed by 5 to 7 notifications a day. Sorry, guys, that's my fault. And then when I was at Google, I built machine learning models to predict if multiple Google Homes heard the same assistant query, which Google Home device should actually reply to you. So one clearly very useful project and one pretty useless project. And my co-founder, Leo, who's not with us today, he was a quant trader at Jump Trading, which is one of the largest high-frequency trading hedge funds out there. He works specifically on their crypto desks, and his models and algorithms currently execute billions of dollars in market value transactions every single day. I don't know if you guys knew, but jump trading is on either side of 50% of every single transaction on chain. So he's a pretty incredible guy, and he was a professional poker player as well. He won $250,000 playing his way through Monaco, Zurich, London, Montenegro, and that's how he paid through high school and college. So let's take a step back and talk about the beginning of digital advertising. This was in 1994, 10 years before I was born. And it was an ad that AT&T paid $30,000 for to be shown on hotwire.com for 3 months and had an incredible 44% click-through rate. If we could all get 44% click-through rates on our ads nowadays, we would be over the moon and incredibly happy. But this is kind of the beginning of how people started to advertise on the internet. People realized that the actual currency of individuals and of consumers was in their intention, right? And where were they directing their attention? To platforms that organically demanded their interest, right? And fast forward to today, this is a screenshot of a typical Amazon search page, right? Every single product on your initial page is sponsored, right? You get served a huge banner ad that is showing three different products from a singular brand, and then your first five products are all sponsored, right? So you can kind of see the evolution from, okay, people were beginning to figure out in the early 1990s, as the internet kind of cemented itself as the core place to gather eyeballs, to actually capitalizing on that and to building the internet and different web platforms as a consistent source to build out organic demand through search and recommendation algorithms. And contrast this to how trading and how buying stocks or buying securities or buying futures was in the 1990s. Back in the day, again, before I was born, to buy a stock of Apple or to buy a stock of AT&T or any other company you wanted to buy, you had to literally go down to the trading pits, or you had to hire a broker to go wave their hand and be like, hey, 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 I want to buy a stock of Apple, right? You have a price in your mind, and then someone else would hear you, walk up to you, you'd say a number, they'd say a number, you'd say a number back, they'd say a number back, and then you get somewhere in the middle where you're both not really happy with, but it's okay because you wanted to make a deal, so you shake your hands and then go do another deal, right? Again, a quick side note: jump trading, which my co-founder worked at, is called jump trading because one of their co-founders was, I think, 5'4". He was very he could not get himself noticed on the trading floor. And to get deal flows, he would literally have to jump up in the air and wave his hand to be able to get deals here. And again, from the 1990s to now, how has that changed? In fact, most trades on the internet and most trades on any exchange are done algorithmically, quantitatively, and systematically. Nowadays, most of the trading pits that involve any kind of human involvement are all closed, right? They've been closed since 2021, right? And right now, the way hedge funds think about how to allocate capital in the form of investments, in the form of, on whatever time horizon, be it on the scale of seconds, minutes, hours, days, weeks, months, or years, it's all done through computational models from hiring PhDs in statistics, math professionals, math professors, the smartest guys out of undergrad, like my co-founder, to basically build algorithms and models to predict the true underlying value of any given asset over a given period of time and find market inefficiencies there. So to really drive this parallel home, how exactly is performance marketing similar to trading, right? When you're advertising on the internet, you have some sort of an understanding of what the underlying value of each ad placement is for you, right? You can kind of think of this as like value per click or expected value per impression as defined by your observed click-through rate or conversion rate across your different keywords and your different products, right? Likewise for trading, you have an underlying model for how much a asset or how much an equity or how much a security or future is worth to you. And then you basically fill an order book, right? And when you trade, you can actually submit your bids and orders to an exchange and you get matched up to a separate party to fulfill that order. And likewise on performance marketing, it's somewhat similar, but you are instead trading in a dark pool where order flow is invisible to everyone and you're explicitly working with or against, depending on how you look at it, at the ad network, right? And how has the evolution in strategies for performance marketing changed from the 1990s to now compared to how the evolution in strategies has changed for trading from the 1990s to now? Performance marketing has kind of basically stayed the same for the last 30 years. To begin with, it was humans running if-else rules to manually tweak campaigns, manually tweak cost per actions, basically just using heuristic semantics to monitor and deploy tens of billions of dollars of capital, right? Whereas now in trading, again, it's hiring the smartest people in the world, the most talented quantitative mathematicians and statisticians and computer scientists to run algorithms that run 24/7, 365, right? And again, for us, it's crazy when we talk to brands where it's like, hey, or talk to agencies or talk to other software providers who, say they do they're data driven, who say they're like, okay, hey, let's use all these ML models, and then you look at where the people who built them came from, and they haven't built anything meaningfully in production at any relevant scale. And then it's like, okay, hey, how does it actually work on the thread? It's like, okay, it's like if a keyword has 20 clicks and less than 2 conversions and lower bids by 10%, where does the 20 come from? Where does the 2 come from? And why is it 10% instead of 8 or 9 or 11 or 12 or 15%, right? And not only that, on top of that, people don't realize the cost of overpaying on each individual placement, right? You can say, okay, if you are within 10 cents of the true market value of a given click or of a given impression, then you're roughly doing okay. But when you boil down it, when you boil it down to the actual math and numbers, if you're overpaying 10 cents per click on a keyword that gets 10 clicks a day, that's $365 a day in wasted spend. If you do that over a keyword or over 50 keywords per product, over a catalog that has 50 products, you're losing $962,500 every single year, right? Which is almost $1 million just because you're overpaying 10 clicks or 10 cents per click, right? It's actually incredible how the scale and how the math works out when you're actually thinking about the extent to which the extent to which these inefficiencies add up. And for us, it's just an incredible thing to see that, hey, how has the industry not evolved beyond if-else rules in the same way that other industries have? We have a bit of time, so I think we can kind of touch on this. I remember when I started Laurence and when we moved into the advertising and e-commerce specifically, I was ridiculed to no end by all of my friends who were in math, computer science, all of my tech friends. It was all like, hey, e-commerce is an unsexy industry. Oh, are you going to make me a dropshipping millionaire, right? And I think this conception combined with the fact that as a 23, 24-year-old coming out of college, you can make a lot of money at a quantitative hedge fund. The kind of talent that would be able to solve this problem, that would be able to build continuous systematic models that you could apply to quantitative trading and performance marketing tend to move toward the finance field as opposed to e-commerce, right? It's a kind of natural market pull because you're not going to make 500, 600,000 US dollars a year working at an ads agency, but you will at a hedge fund. Um, and okay, so what does it mean for brands to actually have a quantitative systematic framework, such as Laurence, to actually manage your advertising and move away from if else rules and go toward continuous systematic optimizations? We've actually found that this results in a massive increase in total sales volume, right? Again, a lot of folks out there optimize for things like ACOS or tacos, and these are two completely flawed metrics because if you want to optimize for your tacos, then you should actually just spend $0 in ads to always guarantee a 0% tacos. Right. And if you want to optimize for ACOS, a 10% ACOS sounds great. But if you're only profiting $200, you would much rather an ACOS of, like 40% and profit a total of $2,000. Right. So our models optimize for total sales, right, minus ad spend. We basically try to optimize for contribution margin for a brand because at the end of the day, all a business is return on investment capital, right? And that's basically what we try to do for brands. And what we've seen is within a week or 2 weeks, we're able to actually increase total sales and total profits by 50% to 100%. So yeah, that's I've been really excited to talk about this for a while. I could talk my head off about what we've been doing, about how I see this market, how I see ourselves positioned here, and everything and anything to do with like ML and statistics. But it's been incredible to talk here and excited to speak to you guys more over the rest of the day. So thank you guys.